I'm Darius McDermott from FundCalibre, and this is the Investing on the Go podcast. The subject of today's podcast is property, and more specifically, property equities or real estate securities. I'm delighted to be joined by Marcus Phayre-Mudge, who is one of the very select set of managers that has an elite rating for both an open-ended fund, which is the BMO European Real Estate Securities Fund, and an investment trust, which is the TR Property Investment Trust. Marcus, thank you very much for joining us.
Thank you, Darius.
So we live in interesting times, and property has been as an interesting asset class as one can find. Let's maybe take a gentle start in with the trust itself. The trust has the ability to invest in both commercial and residential property. Maybe you could talk us through the impact of coronavirus on some of these areas and how maybe you might see some structural long-term change in the property sector because of the virus?
Yes, absolutely. The trust is primarily invested in real estate equities, basically more than 90%, and then has about a 10% exposure to physical property as well. The split between commercial and residential is a little more complicated, in as much as that our residential exposure is not really in the UK. It's primarily in Europe, particularly the majority of it in Germany, but also in Sweden and Finland. And if you could imagine kind of buy-to-let on an industrial scale, that's what we've got exposure to. This is the PRS, the private residential sector. And what's so interesting about residential markets and why they've a sector these particular companies have actually done so well relatively in the COVID crisis is that the rents are regulated. So they are inflation linked, but are in most cases sub open market. As a consequence, and particularly in Germany, where we've seen a lot of support for people who've been furloughed or made redundant, the companies we're invested in have had incredibly high rent recovery rates. So not only are these portfolios of residential units fully occupied in most cases, they've also collected pretty well 100% of the rent, and that's a real positive.
And that's a bit of a difference between the UK, which is much more buy to own, whereas in some parts of continental Europe that you described, renting is far more centred to their culture of how they live with respect to their residential property.
Absolutely, and really that's a function of affordability. I mean, if you could rent the apartment that you wanted to live in, and it cost you a lot less than the mortgage, then you have for many, many years, for generations, you've rented rather than owned. For the UK, where it's open market rents, and there isn't that discount, it's been tougher, and we are less confident because ultimately people's ability to pay their rent and the current passing rents is a function of them having jobs and employment, and that is something that's clearly coming under pressure. Turning to the commercial exposure that we have, what's been fascinating from the middle of February to now is the difference in performance at the subsector level, and that has been crucial to the success of the trust and of our open-ended fund over the last few months. And the easiest way to think about this is the market has been really quite positive about those sectors where the income is secure, probably index linked, and where landlords have been able to recover the rents from tenants. And the most obvious sectors that have enjoyed those characteristics of things like healthcare, nursing accommodation, supermarkets, and particularly logistics and industrial property, all of which where rent recovery has been high. And of course, at the other end of the scale, the consumer-facing real estate, bars, restaurants, hotels, shopping centres, etc., which have been closed or really only open for emergencies, have suffered, and we've seen the rent collection records that there be extremely low. So you had this huge divergence in performance as a result.
What about the office sector? We're all, whether we like it or not, much more familiar for working from home than we were 3-6 months ago. Do you see any sort of medium or long-term structural change with this working from home culture that we've had forced on us because of the pandemic, particularly with respect maybe to the office sector?
Yeah, it is. It's probably alongside, and we'll come back to retail later, but alongside retail, this question of office demand in the future is absolutely the most interesting area at the moment. In the very short run, just to cover that off, we do see risk to serviced office operations and those companies that have quite short lease, where the property companies' tenants have quite short leases, because people will, in the short run, whilst corporates rebuild their cash flows and their P&L, they will look to cut short-term costs. But you particularly asked about the medium and longer-term picture, and there it's much less clear, because on the one hand, we absolutely expect all of us to be working to ultimately end up with a mix of working more from home, but not 100% from home. I think most people realize that they've benefited to an extent, but really, if we only work from home forever, this will be a problem, because that's not how business functions. We need to see our co-workers, we need to engage with that ad hoc conversation in the office, and we need to see clients, and they want to see us as well. What we therefore expect is just a change in working patterns. Now, of course, for the real estate industry, what does that mean for the space and the amount of space that's demanded? On the one hand, the thing that is absolutely clear is there will be what's called de-densification. So over the last 15, 20, 30 years of my career, we've seen a densification. And in fact, the amount of space per worker has got smaller and smaller. When I started in 1990, it was probably 150, maybe 200 square foot per employee. Now it's down to as much as 75, 80, 85. And that's been partly a function of air handling. We've been able to change the air much more better, and also just design of offices, breakout space, etc. So first of all, we'll see a reduced densification. At the same time, because you may be working more from home, but you'll still want to be in the office at some point and have a desk, you can no longer do hot desking. You can't share that desk. So at the moment, it's really up in the air. But I think to be calling the end of the office market and office requirements is premature and probably wrong. What we might see, and this is something we're looking at quite closely and have bought into, is actually a little more decentralization. That actually it may not be in the big, expensive city centres. And by the way, we think always in terms of pan-Europe, not just the UK, because that's our universe. We're able to invest all over Europe. And, someone like Germany, which actually has no one dominant city, there are 6 big cities that are important office markets. We might see them, they all continue to benefit because they have much smaller CBDs, etc. Whereas possibly London may suffer. But on the flip side, and prior to COVID, and over the course of last year, office property companies were enjoying a good recovery post the sort of Boris bounce, as it were. And this was all on the back of a lack of supply of new offices. And in fact, that's one of the key features of real estate markets around the globe, which is really a hangover from the GFC, is that we haven't had a huge amount of speculative development going on in any sectors. And that has been a good underpin. So even though we're going to see this drop off in demand in the short run, and I very much doubt we'll see another skyscraper bigger than 22 Bishopsgate, which has just been completed, that may be the sort of peak of that market. We think the supply is really quite muted. So that's something that should be borne in mind.
Sticking then with the trust, investment trusts have a revenue reserve where the board, at their discretion, can keep some income back to use for future income payments. There's been an announcement this week from the board on the TR Property Trust. Could you give me a moment or two as to what they've said recently?
Yes, so we published our full year results on Friday. Now, of course, as an investment trust, we publish the asset value of the fund every day. So, investors didn't have to wait for that announcement to see what the performance was, either to the end of March or even up to the previous working day. The bit of new information that Jay won't have received until Friday was the earnings per share and the dividend. And in summary, the board decided to pay out for the full year 14 pence in total. And the total earnings were a little bit ahead of that. So the payout ratio was 96, 97%.
That's now, 14 pence per share.
Sorry, 14 pence per share. Absolutely. Yeah. So the dividend yield of today's share price is just under 4%. Now, bear in mind that lots of property companies have announced that they are cutting or withholding dividends looking forward for the year that we're now in, the year to March 21. Some investors might be surprised that the board was so robust and positive about that. And the answer is, to your point, they have revenue reserves, and our revenue reserves total approximately 14 pence per share. So if we receive no income for the whole of the year to March 21, technically the board could use those reserves to pay the dividend. Now, the reality is we will lose some earnings because we're already looking forward into March 21 because of these companies that have decided to withhold or not pay dividends, and that's where these reserves could well come in to be used because that's what they're there for. They're there to help top up in periods where we don't get where dividend levels fall. But very importantly, given that our exposure to healthcare, to supermarkets, to residential, to industrial and logistics, these are all sectors who we think are going to continue to pay full dividends. And we have very little exposure to retail. In the UK, it's just our supermarket exposure, which is fine. And in Europe, it's less than 5% of the assets of the trust. So I think, in conclusion, the message from the board of a full payout ratio is, look, you shareholders have this money's been earned by the trust, and we believe it should be paid to you as earnings for the year to March 20. But we have these reserves, and we wanted to highlight that. The board wanted to highlight that, which can be used then looking forward. But also, it was also a comment about the strength of some of the earnings that we're already seeing coming into our revenue account for the first quarter of the new financial year.
Brilliant. Let's just touch briefly then on your open-ended fund, the BMO European Real Estate Security, which is elite rated by FundCalibre. Now, you have some slightly wider powers where you are able to use some short positions selectively to take greater underweight positions against a benchmark. Has that been helpful in the falling markets for that fund? Absolutely.
As you said, this fund is not a long short fund by any stretch of the imagination. It has the same benchmark as TR Property. What it does have is, as you point out, that extra tool in the box in the UCITS structure where we can have short positions. So we find it particularly useful where if there is a relatively small company that we aren't positive about, obviously in TR Property we can only have a zero holding in that. Whereas in ERES, in the European Real Estate Securities Fund, we can exhibit greater negative conviction by having a short position as well. Now, we're very careful to make sure that and as we always have done, you can look at our presentations on the website, either on the TR Property or on the ERES website, we very much look at our world in terms of subsectors. And therefore, we will, if we have that negative conviction on one particular stock, we're almost certainly going to have some long conviction in another stock in that subsector to make sure that we don't get caught out particularly badly. But yes, in the period, in the sell-off from the middle of February to the middle of March, which was very aggressive, it did benefit us.
Brilliant. Now, maybe a moderately brief but last killer question. Given where we stand today, can you give me a broad outlook for your property real estate securities, maybe over the next 5 years? Do you think the prices are now favourable looking forward?
I think it's, the core reality is that we are going to be in a period of very low interest rates for a long time, longer than we had hoped last year, as a consequence of this huge amount of state and central bank funding. Central banks really have to operate, really have to encourage capital repression, where they need negative rates in many long duration assets are, we think, here to stay. And therefore, investors are still going to need income, even more than they were in the past. And that's where quite a lot, but not all, real estate sub-markets, sub-sectors should be able to help contribute towards that. We remain very nervous about retail, and I'm afraid for hotels and bars and restaurants around the world, and for travel, it's really going to be a question of vaccines and how we all deal with that. But we'll focus on those other markets that continue to drive that income, and that's something that we hope to deliver. And if, unfortunately, further down the line there is this risk of inflation as a way of getting rid of the debt mountain, then I'm afraid it's better to own real assets, and bricks and mortar is going to be in that category.
Marcus, thank you so much for that fascinating run through your asset class. As you said, there's lots of subsectors, not all of them behaving in the same way. And fortunately, you've been on the right side of the better sectors for both the TR Property Investment Trust and the BMO European Real Estate Securities.
Thank you very much.
If you'd like to get more information on these funds and trusts, please go to FundCalibre.com. And if you'd like to subscribe for the Investing on the Go podcast, please also visit FundCalibre.com. Please note that these are unprecedented times and markets can react very quickly to news. The views expressed here are at the time of recording and could obviously change.
Please remember, we've been discussing individual stocks to bring investing to life for you. It is not a recommendation to buy or sell. The fund may or may not still hold these stocks at the time of listening.